Hi guys, welcome to Paradox of Losing Cycle channel. Today we're going to talk about the detrimental losing cycle in forex trading. Forex trading can be known as margin trading or day trading, as well as futures or spot trading, and as well as derivatives. So the objective of this video is to describe how the margin trading or forex day trading is similar to gambling and how the similarity is so striking that it's the same as gambling. The more you spend your time in day trading, it has a tendency to follow the detrimental losing cycle, where the MPL, which is the marginal propensity to lose, takes over, and your cash flow constantly will be under pressure and volatility over time as you continue day trading. So let's start, and I hope that you will enjoy the video. So, Forex day trading is a trap, similar to gambling. Now, let's describe what are why is it a trap? Now, there are three traps in Forex day trading. The first is when you first encounter, Forex day trading is like when the first time when you go and download an application of MT4 or MT5 or similar platform where you try the first trade, and as you hit the first win is usually highly addictive. Now, it doesn't matter how big or small is the first win, it's highly addictive. And the dopamine effect takes over on the first win, keeps you craving for more wins. So as you encounter the first win on your first trade, it feels like free money, right? So basically, uh, you're gonna start craving for more and more similar wins, and therefore you get addicted. Now, the second trap is believing you can win on every trade. Um, Now, each trade, similar as gambling bet, is uncertain. The outcome is uncertain. So the uncertainty on every trade is driving you constantly as a thrill effect. Okay, and constantly trading and chasing wins or losses nonstop, and riding the detrimental losing cycle, therefore, with incremental losses. Why? Because you are considering losses as a redemption to future win rewards. Meaning, whenever you lose, you don't consider them losses. You consider them as necessary losses in order to redeem future rewards. That's a dangerous kind of thinking. I mean, this is why you just keep going, because you don't feel your losses. You feel, and you're enjoying the losses because you take the losses as a necessary evil in, in order to keep trading, so that you can come up with future reward. Okay. Now the third trap is believing you can become rich day trading. Now, this is usually, sometimes, you have like a 1 million target to reach. You're going to say, well, I'm going to start with $1,000. I'm going to take it up to $1 million. Or I'm going to start with a $10,000. I'm going to take it up to $1 million. And it could be that because you saw a YouTube video on a young teenager making millions, or you read a book on a day trading, a day trader retiring as a millionaire day trading. You might have seen a video on a hedge fund manager making billions. They're all over the YouTube, such videos. And unfortunately, the thing is, like, on those videos, you don't know what circumstances this hedge fund manager went through. He might have lost billions to make billions. Okay, so you cannot just take one story of somebody who made a million without understanding the background of this person. But unfortunately, the crowd, many retail traders, they get so excited about trading. So these are the three traps usually they get into and get trapped for a long time. By the way, some these traps can take you maybe 10 years, 15 years, and you won't be able to get out of it. All right. So let's go to the next slide. Okay, now uh, this slide is about the price action. A price action is the price movement on the chart. So while you are watching a an instrument such as Euro USD or GBP USD or gold XAU USD or silver or oil, it could be index, could be a stock, any instrument. While you're watching the chart, when the price is moving with volatility, it's called price action. And price action, normally what happens is that people, traders, they don't understand the mechanism behind the price action. The mechanism behind price action is that, whenever you execute an order, your broker basically transfers this order book to either a market maker or to a liquidity provider. So a market maker or a liquidity provider, they usually have this order book receiving all these orders getting executed by the broker's platform like yours on MT4. They receive them on an aggregated fashion. So when they have the order book, it's not transparent. No one can see it except the market maker or the liquidity provider. So you have no clue about the order book in the market. So it's a very non-transparent or order book. Nobody can see it, and unfortunately, this this stays as a disadvantage to trader. Okay, because when you are trading a stock market, sometimes you can see the order book, or if you are trading a crypto, you can see the order book. The Bitcoin or crypto. If you go to the spot trading platform or futures platform on Binance or Kraken, on futures platform, you can see the order book. But on Forex trading, you can't see these order books. So that's a disadvantage. And it's a huge disadvantage, by the way. Okay, so, you know, now let's talk about the price action. So basically, when you execute these orders, there are hundreds and thousands and millions of traders. They're executing orders. These orders, it goes as an order book to market maker or the liquidity provider. Now, the market maker, this is how the order book is structured. On the top, you have sell orders. On the bottom, you have buy orders. In the middle is market orders. So these sell orders or the buy orders, it gets accumulated over time. Sometimes it's real time, sometimes it's not. It depends on the market maker and the liquidity provider when they are going to execute them. They have the full luxury to wait and sit on these orders and dump them in the market whenever they feel like. Okay? Now, whenever, let's say, somebody executed a huge lot size on gold, for instance. Okay, it made a sell order. So what happens here, you can see on the slide. Now that basically somebody placed a sell order. Okay, it got executed on market order. So the current price goes away. The price basically goes up to P3. Now what happened here? The guy, he just placed a sell. What happened to the price? Price moved up. Why? Because you know when somebody places a sell order, it creates a vacuum here between the sell order and the market order. It's a huge vacuum. There's a gap. So what happens to the price? That this gap gets filled. Okay, this gap gets filled with liquidity, pushing the prices higher. So assuming that if you sell and then you're going to enjoy lower price, that's not going to happen. It might happen in the future, but not immediately. Immediately, the price is going to turn back on the opposite side. Okay, so sell, liquidity gap. This is a market order. It gets executed here. Liquidity gets filled in this gap, and the price moves up. Now, if you place a huge lot size, immediately you're going to get covered. And with a little bit more of liquidity to the upside, this position will be taken out, especially if this trader went all in with a very high leverage, such as 1 to 500 or something like that, is going to get taken out. So please try to understand this mechanism of the order book, how it operates in Forex trading. Okay? So it's not like you see the price and you want to immediately, you know, make a lot of money so that the price can move down, and then you're gonna basically, take your position out here. That's not gonna happen because the price is gonna go against you immediately, on immediate effect, and you really have to sit on this trade for a while before a lot more execution in the market gets executed as market order on the market makers and liquidity providers platform. That will take some time before the liquidity gets filled on multiple orders. And it depends, it depends how many how many sellings is going on and how many buyings are going on. It all depends on. So it's not a straightforward phenomenon, especially if somebody is, placing a huge buy order or a huge sell order, is going to go against their position immediately or in a very short time period. So I hope that you understood, how the price action works in forex trading. All right, so let's go to the next slide. Now, the main problems in forex trading is there is a lack of awareness. Uh, Majority don't understand how, the industry works, and people just don't understand how the margin trading works mechanically. And also, they lack the knowledge on how market makers work and how order books are managed. People are not aware that there is no exchange whatsoever on CFD platforms. So when you are trading Forex, there is no exchange, by the way. It's just between you and the market makers and liquidity providers. They are taking your markets and they are executing it on their liquidity pool. So there is no exchange. And MT4, MT5 are run by brokers who are linked with market makers and liquidity providers. There is no P2P transaction. So it's not like, you are buying and another person is, or let's say you're selling or another person is buying from you. It's not like that. There is no peer-to-peer transaction in this platform. It's just you and the liquidity provider or the market maker. And there is a lack of regulated exchange. Yeah, so that's what we just said. There is no exchange in this industry. So market makers, they can trade against the dominant side to balance the price, and they are fully licensed to do that. So let's say a market maker can, you know, if there are too many long positions, they can actually, trade against them. Okay. Brokers can hedge their positions placed by the traders. The liquidity providers are not transparent about what they do with order books, and banks and institutions can do front running and manipulate the price. Front running is basically, they buy a huge, let's say, you want to buy Euro USD. So what the banks can do is that they can buy a huge amount of Euro USD and can sit on it and then sell it to you later when the price go up. So basically, and pushing the prices even higher, something like that. So basically, it's called front running. Okay. And it's forbidden, by the way. Banks, they do this, they can get caught and they can get penalized in billions of dollars by the regulators. And it happens so many times, by the way, by big names. And your orders can also stay on B book by your broker or by the market maker, which means that it doesn't see the sunlight into the market. It's not executed in the market. They're just waiting for you to take a trade and then so that you go bust, meaning that they will watch your trade and then they will see your stop losses and they will see now where uh, the moment that you get liquidated, because sometimes they will analyze your trading behavior. If you are very high risk taker, they might not execute the markets because they know that you're going to lose. So they just wait for you to lose. So when you are a risk taker, let's say on 1 to 500, and the market volatility is very high, and you've been constantly losing, so it's quite predictable for the broker to see that you're going to lose every trade you place because you are a risk taker. So in this case, you place a trade, there is a volatility, and then they can see the price have reached your the margin, and they will liquidate you immediately, and they will keep your funds. Okay, so therefore they will take the advantage of the situation whenever they see that you are a risk taker. All right, so it's called that B book. It's a very well known phenomenon, by the way. So these are the things that the traders are not aware what's going on in the forex industry. All right. Now, a trade as a day trading. like scalping, is equal to bet and is equal to gambling. So we will explain that how, why. So, first is the cash flow volatility, same as gambling. Okay. So, same as gambling, the ups and downs due to price action volatility creates an uncertainty and the thrill of the price moving to the anticipated direction. So, when you're trading, you're anticipating a direction. So, this anticipation combined with uncertainty will create a thrill in the atmosphere. So, this is what's driving you. Okay. Same as a bet, a gambling bet on a blackjack or on poker or on a baccarat or on a slot machine. Same thing. Basically, you're betting, and every bet is uncertain. The outcome is uncertain, and that's what is really thrilling. That's what you are enjoying. Okay, that's where the dopamine gets released, even before you place the bet. By the way, just the uncertainty creates a thrill. All right, so because you're like, oh wow, the price is moving this direction. I know that it's going to go up there, so you're going to go all in. So basically, same thing. Okay, so the price action volatility, the market, the volatility creates, a lot of uncertainty, and that's what's makes you going. The thrill of the price moving in a direction, and then you placing a bet. So that's same as gambling. And then you got scaling up the trade size is similar to gambling, where the bets or the trade sizes or the lot sizes in trading scale up due to interim wins, leading to relief from stress and increase in confidence level. So let's say you scalped a trade and then you won. You made, like, let's say, $500. That's it. Your confidence level will go up. Before you won, you were under stress, but at the time you took your profit, your stress level goes away, your confidence level goes up, and then you come back and trade again, and you start scaling up your trade sizes because of the overconfidence. That's the same as gambling. And then same as gambling, chasing losses. So when there is an initial loss, same thing. Okay, the trade size escalate and sometimes go full margin. A full margin here is equal to going all in. So when let's say you scalp once, you won. You scalp second, you lost. So in this case, when you lose, you feel like you have wasted your time. So you get pissed off. You go on tilt, and then you go bigger lot sizes just to make up your losses and your time lost in trading. So and the moment you go larger lot sizes, you will start losing more. Okay. Trading systems and methods, same thing. In gambling, you have systems. In trading, also, you have systems and methods. All the systems in trading, they fail over time. Same as gambling. Every system could work in the short term but fail over long term because systems cannot predict the manual interference by market makers, liquidity providers, and institutions such as central bank and other hedge funds. So, any system, you're trying to predict the pattern because uncertainty creates some kind of ambiguous situation where you want to find a system to help you to predict. But these systems can help you sometimes, a few times, but over a long term, on a consistently, if you use these trading systems, it's going to fail because there are many volatility and spikes and aggressive moves in prices due to interference by market makers, by central banks, by the institutions, where I mean, no system in the world can predict, what these large institutions are doing. So it's foolish to use the systems in the first place. But you might say, well, I'm going to use the trading system in a quiet, time when there is no news. It doesn't matter because, in the market, you don't know when the war is going to start, when, some guy is going to say something, or some unknown situation can happen, and anything can be acquired by the market makers and take the advantage of the situation, and then they manipulate the price. So the manipulation of the price is a big thing, and you cannot predict them. No system can predict them. No algos, no algorithms, no bots, nothing. So usually these systems fail. Okay. All right. So the second factor is the time frame. Okay, and same as gambling. So basically, same as gambling, the more the time you spend scalping and day trading, the higher the chances of ruin. And same as gambling, marginal propensity to lose, the MPL, is pushing your cash flow downward, one MPL curve over time. We will explain that on the on next slide. Same as gambling, you don't have time to spend with your family, friends, and you hate to go to work. You would just rather stay glued to the screen, watching every tick up and down. All right, so very, very, very similar to gambling. All right, so let's move on to the detrimental losing cycle. So now we discussed this on gambling, and I'm going to describe this within the context of trading, how how this the losing cycle works and the MPL. So so you have the x-axis is the time frame, and the y-axis is the cash flow, and that curve downward is the MPL. We call that MPL one, and it's a downward curve. Okay, basically what it's saying is that as the time passes by, your cash flow is pushed downward, and there is a as you are trading, there are ups and downs in your trades. So you are scalping here. You might be doing swing trades or scalping, but mostly it's scalping. Um, if you are scalping, basically you have gains and losses, gains and losses, gains and losses. But on a cumulative effect basis, your cash flow is declining because there are so many gains and losses. There are commissions involved in these trades. There are spreads. There are swaps, and there are also losses. On your executions when your scalps can go wrong. Sometimes you gain, sometimes you lose. But if you realize over time, it's being pushed downward. Your cash flow is being pushed downward, okay, on an incremental basis without you noticing because you're accepting the loss. Remember, you're accepting the loss as a future redemption to reward. So that's why it's going up and down. So over time, your cash flow is getting chewed up, it's getting chunked, it's getting pushed downward. It's never being pushed upward. Okay, we will describe the upward phenomena. How does it happen? So here's the cash flow and the time frame. You got C1, C2, that's the cash flow 1, cash flow 2, and you have a time frame 1, time frame 2. And that's the cash flow decline. So basically here, as the time passes by, you are scalping, you are trading, suddenly you realize that your cash flow have declined from $1,000, for instance, to $500. Okay, now since you're heavily scalping and your cash flow is declining, you are stressed, and here now you are desperately waiting for some kind of news in the market or some kind of spike because of some kind of event that you were anticipating or announcement by the Fed or by some, you're hoping that it will go to your favor. And spike comes, and the Fed, maybe the Powell, he talks, and then suddenly there is a spike. Now this spike could go either down, could go up. All right. So either you go to the ruin or you will gain some profit. The unfortunate factor in trading is that the market makers, they drive the price, by the way, both sides. So sometimes what they do is they push the prices down. It takes you out and then push the prices up. So you might as well just go into a ruin before you go into the profit. So that's a threat you need to manage, and it's an ugly threat. And this is why forex trading is very dangerous to trade. Okay, so on a hypothetically, let's say you won. Let's say you survived this downturn spike when the Fed talked, and then it went up, and then you realized some profit. Lucky you. Okay, so let's say you realize a profit, okay, and you are now sitting on the peak. So what happens here, the curve shifts up. The MPL curve shifts up from MPL1 to MPL2. And now, since you have won, you're going to be starting now trading on a larger lot sizes. So you're going to be facing bigger volatility on your cash flow, and your cash flow again is it's being pushed down because you haven't stopped trading since the last peak. And then you're wishing, why didn't you get out of the peak? Because you are under stress, and your trades are bumpy. It's going up and down, up and down, up and down. Your scalps are making some profits, some losses, making, and it's not consistent, and it's driving you nuts. So your cash flow again is being pushed down. Your losses are bigger now. Now you're expecting another spike to come to save your situation, and then basically the spike comes, And same thing, it can take you down to the ruin, or it can take you up. Okay. Let's say it took you up, same thing. You will keep on trading as if you are, a gift from God, a God-given gift to trading. And then you might say, hey, I'm the genius. I'm the market. I know everything. And then you're gonna start scaling up your trade sizes. All right. So it goes to MPL 3 from MPL 2, and then there where basically you are now trading in much bigger lot sizes, because that's it. You started out grinding here on MPL 1, and then you marginally increased your trading lot sizes on MPL 2, and then it became much bigger in MPL 3. Same thing, you will suddenly realize your losses are getting bigger, and then you are expecting a spike comes, and this one might, it just, the market makers will take you down completely to the ruin, or it can slightly take you up, and the cycle continues. So, guys, I mean, that's a down cycle. So it's the same as gambling. Trading and gambling has so much in similarity. Unfortunately, trading has a bigger risk in terms of that the market maker has full control over, taking you down to the ruin, and you need to manage that. Okay, so this is really disturbing to know. And you need to really manage this. And the only way you can manage this is that you need to realize this down cycle. And you need to realize that what you're doing in terms of trade sizes, you need to keep it down. You need to keep down your leverage, your lot sizes, and knowing that the market is full of volatility and these spikes can actually cause a lot of harm to your cash flows. Okay, so you need to keep it down. You need to, so I don't want to say, to quit this, trading completely, but the purpose of this presentation is not for you to quit, you know, trading, but this is to make you aware of the risk and the threats that is available out there in the market that you should be aware of. And it's up to you, how you want to define a solution to this trading based on this facts. I hope you enjoyed the video. Please press on the subscribe button. We will be producing more videos like this to explain things mathematically and economically, rationally, and for you to design your own solution, how you want to manage your different scenarios of losing cycles. And that's our objective. Our objective is to transfer the knowledge to you. Thank you guys, and hopefully we'll see you on our next videos. Cheers.